Hello, this is Cynthia Fick, and this is the August 12th stock market update. Well, today we had a CPI number that came out a little bit tamer than we'd been expecting. And so now it looks like almost a 98% chance that in September, when the Federal Reserve meets, they're going to most likely lower interest rates by at least 25 basis points. So that is, kind of good news for the market. What we've been expecting, what the Trump administration seems to want, so they can lower interest rates and refinance all the United States debt. So that is perceived as a positive for the market. Another thing, just to follow up on, I mentioned there were three acts bills that were up in the Senate and the Congress, and they were looking at approving some things on digital assets, mostly for regulation and standardization of different practices and how we transact commerce internationally. And all three things were passed. And so this is kind of a thing that's coming along the line. I know it seems like it's, you remember the olden days where we were talking about the World Wide Web, and now we're talking about digital assets. And so just something for those of you who are negative on digital assets to at least keep an open mind, because it does seem to be, the way banks may transact business in the future. The third thing to talk about is a lot of people are asking me, Cynthia, the market's doing so well, our accounts are doing well. And again, that's because we do tactical asset allocation and we're buying the stocks that are doing the best after we lay the foundation of our core holdings. And so we try to do better during these times. But as Gina mentioned last week, there's two different markets right now. There's that kind of meme stock market, maybe the younger generation on Robinhood trading stocks every day and running things up and down. So that's the more aggressive, but there's also the older, more fluent population who's still a little hesitant about the market, like some of you, saying, I don't know, how much farther can this go? And so that's kind of keeping that $7 trillion on the sidelines. And what I think could fuel the fear of missing out kind of rally that we may experience towards the end of this year. Inflation is looking much tamer. The economy is slowing, but hasn't screeched to a halt. Jobs numbers are okay. And corporate earnings are coming in really strong. Plus, we have the productivity of the things that are doing really well, artificial intelligence, and even the digital assets. This is kind of changing the landscape of our economy. So these are the things we're looking at. Going to spend a little bit of time looking at some charts and looking at what's happening right now in 2023 to 2025 in the S&P 500. So again, the question is, are we too far ahead of ourselves? And kind of comparing that to the long term, it's almost like a 100-year trend that says right now we are in a secular bull market, means the general trend is up. And, we've had two 35% corrections in the middle of this. So 2020, 2022, we had big corrections. But again, the general trend has been up during this time. Could we break that trend? And this is the trend line way down here. These are all moving averages. And yes, we could break that. And that is why you have us. That is what we're watching. But, so far, so good. This is the S&P 500 and how it's traded. It kind of in February to May, we had the pullback because of tariffs and did a big V-shaped kind of recovery type of thing. And here we are kind of breaking out into new highs. So that's where we're at right now. Let's compare that to in other periods of time where the market really did start to break down and break some of those long-term trends and compare that. So we're looking at 1968 to 1969. There was an 11-month period of time where the market had been trading nicely above the moving averages and started to kind of break down and bust through a lot of the moving averages and then just could not catch its footing. It tries to rally, it does, and then just continues to break down. You see all the moving averages are just kind of converging, and it looks super messy. And we eventually go on in the early 70s to break that long-term trend. Okay, so here is where we're at in 2024, 2025 for 11 months, the same amount of time. Here's what the market looks like. We've been trading nicely above all the moving averages. We had the tariff scare and, definitely pierced a moving average, and then have started moving up, like I said, into new highs. Could it go down and break this? It could, but again, that's why you have us. That's what we're watching. And at this moment, we do not see a sign. This chart looks a lot different than this chart. So hope you guys have a great week, and we will be seeing you next week. Bye-bye.